Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Oh boy, looks like investors around the world are waking up to a bit of a market hangover this morning.
You said it.
CNBC's live blog is showing a pretty
Yeah.
gloomy picture of the Asia-Pacific markets.
Definitely a sea of red out there.
Yeah,
CNBC is reporting widespread market drops across Asia-Pacific,
right.
mirroring what we saw on Wall Street yesterday.
Yeah.
Japan's Nikkei 225 taking the biggest hit, down over 2% as we speak. South Korea, Australia, Hong Kong, mainland China, nobody's immune.
I think this is a classic case of fear driving the markets,
Yeah.
President Trump's attempts to kind of smooth things over on the tariff front haven't really calmed investors' nerves.
Right.
They're still really on edge about a potential global trade war and what that could mean for economic growth.
Yeah, it's like everyone's bracing for a punch that hasn't landed yet. Makes you wonder what it would feel like to be an investor in Tokyo right now, watching your portfolio shrink as the Nikkei tumbles.
Right.
Talk about a stressful way to start your Friday.
Absolutely. And this fear is spilling over into, real economic consequences.
Yeah.
The Wall Street Journal had a piece titled China's Export Growth Disappoints Amid Trade Tensions that really highlights this point.
Oh, yeah. China's export numbers are definitely raising some eyebrows.
Right. Their export growth slowed significantly in January and February, only a 2.3% increase. That's way below the 5% growth analysts were expecting.
Wow. Remember all those photos we saw a while back of mountains of shipping containers piled up at ports?
Oh, yeah.
The Wall Street Journal is suggesting that was likely a temporary surge as exporters rushed to get ahead of the tariffs.
Exactly. It was a bit of an artificial spike, and now we're seeing the market kind of correcting itself, and the impact of those higher U.S. tariffs is becoming much more apparent.
Okay, so we've got markets dropping and exports slowing.
Yeah.
But wait, there's more. CNBC is also reporting some surprising news out of Japan. Their long-term government bond yields are skyrocketing.
Now, this is where things get really interesting. Japan's 20-year JGB yield climbed to 2.25%, and the 30-year yield hit 2.556%.
Wow.
Those are levels we haven't seen since the 2008 financial crisis.
2008. Wow, that's a long time ago, and not exactly a period we want to revisit.
Right.
What's going on here? Is it all about the tariffs?
Well, the tariffs are definitely playing a role, but there's more to it than that. Japan's increasing defense spending is also putting upward pressure on yields, as is the anticipation of early rate hikes by the Bank of Japan.
Okay.
For listeners who may not be familiar, JGB stands for Japanese Government Bond, and its yield reflects how much return investors demand for lending money to the Japanese government. Basically, a rising yield means investors are getting nervous.
So it's like a triple whammy: tariffs, defense spending, and potential rate hikes, all adding fuel to the fire.
Yep.
CNBC also mentioned that Japan's finance minister issued a warning about excessive volatility in the foreign exchange market, driven by speculation since December.
Right.
It sounds like everyone's a bit on edge.
There's definitely a sense of unease in the air.
Yeah.
It's a complex situation with multiple factors at play.
Right.
But speaking of complex situations, let's shift gears for a moment and talk about the Eurozone.
Or
Bloomberg had an article titled, Eurozone Economy Grew More Than Estimated at End of Last Year. That caught my eye.
Okay, so a little good news amidst all the doom and gloom.
Well, sort of. The Eurozone economy did grow more than initially predicted in the last quarter of 2024, 0.2%, versus the 0.1% prediction.
A win's a win, right?
True. But it's important to note that this is still a significant slowdown from previous quarters.
Yeah.
And there are a few factors contributing to this.
Like what?
Well, there's a lot of political uncertainty in Germany and France right now.
Right.
And the ripple effects of President Trump's policies are creating a drag on investment and export across the Eurozone. Remember those German factory orders we discussed? The Wall Street Journal had that piece titled, German Factory Orders Slump, again, as hopes grow for stimulus to counter tariff threat.
Right.
This uncertainty is likely playing a role in that slowdown.
So it's like a domino effect. Uncertainty breeds hesitation, which leads to slower growth.
Yeah.
Makes you wonder how this is all going to play out on Wall Street.
Right.
And wouldn't you know it, MarketWatch has an article titled, NASDAQ Falls into Correction as S&P 500 Tests Line in the Sand. Watch these levels. That tackles this very question.
It seems like fear is contagious. The U.S. markets are definitely feeling the heat. The NASDAQ composite fell into correction territory, meaning it's down 10% from its recent highs.
Right.
And the S&P 500 dropped 1.78% and is now testing its 200-day moving average.
Okay.
which is a key support level.
Okay, for those of us who aren't professional traders,
Right.
what does that actually mean? Break it down for us.
Sure, the 200-day moving average is essentially a trend line that technical analysts use to gauge the overall direction of the market. When the S&P 500 falls below this line, it can trigger a wave of selling as investors get spooked and start dumping their stocks. This can push the market even lower.
So not exactly the news anyone wants to hear on a Friday morning.
Right.
But hold on. MarketWatch also had an article titled, JP Morgan says the stock market may need more time to get to its year-end target, that offered a slightly more optimistic outlook.
Yeah, JP Morgan is suggesting that while the S&P 500 might not hit their year-end target of 6,500 until 2026, the market could rebound later in the year.
Okay.
They argue that falling interest rates, a weaker dollar, and lower oil prices should eventually help support risk assets.
Yep.
They don't see a recession as a high risk, which is a bit of a silver lining.
So maybe there's a light at the end of the tunnel.
Possibly, but it's important to remember that the market is currently reacting to what they perceive as policy-induced growth fears.
Yeah.
Basically, investors are worried that the government's actions, particularly on the trade front, could stifle economic growth.
So it's like a tug of war between fear and optimism. And speaking of things that can pull the market in different directions, Bloomberg has an article titled, Market Looks to Jobs Data to Revive Sputtering Treasuries Rally, that suggests bond investors are eagerly awaiting today's employment report.
That's right. They're hoping to see signs of U.S. economic weakness in the jobs data, which could influence the Fed's decision on interest rates if the jobs report is weaker than expected. It could push the Fed to cut rates, which could provide a boost to the stock market.
So it's all interconnected. The jobs report, the Fed interest rates, the stock market.
Right.
It's like a giant, complicated puzzle.
It certainly is. And speaking of interconnectedness, the European Central Bank, ECB, just cut its key rate for the 6th time in 9 months.
Wow.
Barron's had an article titled, ECB Cuts Rates Again as Trump Tariffs Stoke Fears for Economic Growth, that dives into this.
Wow, 6 rate cuts in 9 months?
Yeah.
That's a pretty clear sign that they're concerned about the state of the Eurozone economy.
Absolutely. They're trying to stimulate growth and counter the negative effects of the trade war, but there's only so much they can do in the face of such global uncertainty.
It's like they're trying to steer a ship through a storm with limited control over the wind and waves. Speaking of uncertainty, we can't forget about the impact of Elon Musk's involvement with the Department of Government Efficiency, or DOGE.
Ah, yes. The Musk factor, according to Bloomberg, tens of thousands of federal jobs have been cut in the weeks since President Trump took office. The full impact of these cuts is still unknown, but it's definitely adding to the market's anxieties.
MarketWatch even had an article titled, The Next Wave of Federal Employee Job Cuts Will Be the Most Brutal. People are worried about how these job cuts will trickle down and affect the broader economy.
It's definitely a situation to watch closely. And speaking of situations to watch closely, let's talk about Tesla and the buzz surrounding CEO Elon Musk's political activities.
Right. This has been all over the news.
Yeah.
The Wall Street Journal had a piece titled, Tesla's Fortunes Fall as Musk Rises in Trump World, that highlighted how Musk's growing political presence is impacting the company.
It seems to be a double-edged sword. On the one hand, his connection to the administration could open doors and give Tesla a competitive advantage.
Right.
But on the other hand, his outspokenness and controversial views could alienate some customers and investors.
And then there's MarketWatch, with their article, The Biggest Tesla Bull on Wall Street Says the Sell-Off Over Musk Politics is Overdone. They quote Wedbush analysts who believe that less than 5% of Tesla's global sales are at risk, despite the negative press surrounding Musk's political affiliations. It's fascinating how opinions are so divided.
It's a classic case of a company's fate being intertwined with the personality of its CEO. Only time will tell how this will all play out for Tesla.
Okay, so we've covered the markets, the tariffs, the job cuts, and even a bit of Elon Musk drama.
Right.
But we can't forget about Bitcoin and what's going on in the wild world of crypto.
Well, it seems like President Trump has decided to make a splash in the crypto pool. Bloomberg has a couple of interesting articles on this. Bitcoin drops after Trump executive order disappoints market. And Trump signs executive order creating strategic Bitcoin reserve, crypto stockpile.
So he's creating a strategic Bitcoin reserve. That sounds pretty groundbreaking.
It does, but the details are a bit more nuanced. MarketWatch even had an article titled Trump Signs Order Establishing Strategic Bitcoin Reserve. But it's not what crypto industry ultimately wants that dives into this.
But what's the catch?
The order states that the government won't be using taxpayer money to fund this Bitcoin reserve. Instead, they'll be using Bitcoin that's already owned by the federal government, mostly from seized assets. So it's not quite the massive endorsement that some crypto enthusiasts were hoping for?
So more of a symbolic gesture than a market-moving event?
Exactly. It's more about signaling recognition of Bitcoin as a potential reserve asset than actively injecting government funds into the market. And that's why we're seeing Bitcoin prices drop. The initial excitement has faded.
It's amazing how much power one announcement can have on a market, even if it doesn't quite live up to expectations.
Yeah.
Speaking of big announcements, we have to talk about the Walgreens news. The Wall Street Journal is reporting that Walgreens seals $10 billion take-private deal with Sycamore.
This is huge.
It's one of the biggest leverage buyouts in recent years after nearly a century. As a public company, Walgreens is going private.
Wow, that's the end of an era. What does this mean for Walgreens?
It means Sycamore Partners, the private equity firm behind the deal now, has a lot of freedom to make big changes. They won't have to answer to shareholders every quarter, so they can focus on long-term strategies.
Yeah.
The Wall Street Journal suggests they're planning some major restructuring.
And it makes sense. Walgreens has been struggling for a while now to keep up with the changing retail and healthcare landscape. Maybe going private will give them the breathing room they need to revamp their strategy and become more competitive.
That's the hope anyway. But pulling off a turnaround of this magnitude is a massive undertaking. It'll be interesting to see if Sycamore is up to the challenge.
Right.
Okay, so we've covered a lot of ground here. Markets, tanking exports, slowing Japan's bond yields, going haywire. Elon Musk shaking things up, Bitcoin taking a dip, and even a major retail shakeup.
It's been a busy week.
It's been a whirlwind of a week in the financial world.
It certainly has, and the big question on everyone's mind is, what happens next?
Right. With so much uncertainty swirling around the globe, it's hard to predict what will trigger the next market move and whether it will be up or down. I guess we'll just have to wait and see.
Exactly. But one thing's for sure, it's going to be a wild ride.
Buckle up.
Yeah. And, amidst all this economic turmoil, it's easy to forget that there's another layer of complexity at play.
Yeah.
The political landscape.
Oh, absolutely.
And President Trump's approach to trade has, especially with those tariffs, has definitely kept the markets on edge.
It's like trying to walk a tightrope during an earthquake.
Yeah.
One minute, things seem to be calming down, and the next minute, there's another tremor that throws everything off balance. The Wall Street Journal even had a piece titled, "Trade Stress Slams U.S. Stocks."
Yeah.
That really captures this feeling.
It's a great analogy, these sudden shifts in tariff policy. They create so much uncertainty for businesses.
Right.
They don't know whether to invest higher, expand. It paralyzes decision-making.
And when businesses hesitate, the economy hesitates.
Right.
It's like a chain reaction that ripples through everything.
Exactly. And the Wall Street Journal also pointed out that this back and forth on tariffs is affecting everyday consumers as well.
Yeah.
People are worried about prices going up.
Right.
So they're holding back on big purchases.
Makes sense.
Which further slows down the economy.
When you're not sure what the future holds, you tend to tighten your belt and wait for the dust to settle.
Right.
But while we're waiting, the markets are reacting in real time.
Right.
Bloomberg had an article titled, "U.S. Stocks Whipsawed by Tariff Confusion Teeter Near Key Level," that really highlights this.
Yeah. They're saying the S&P 500 is on track for its worst weekly loss since September. It's a clear sign that investors are nervous and they're voting with their wallets.
Yeah, the market really does hate uncertainty, doesn't it?
It does.
And right now, uncertainty seems to be the main course on the menu.
It's definitely the flavor of the week.
Yeah.
And Bloomberg also pointed out that, market volatility is on the rise. Their fear gauge, also known as the VIX, is climbing.
So for those of us who don't speak fluent marketese,
right,
what does that mean exactly?
The VIX is essentially a measure of how much stock prices are expected to fluctuate in the near future. The higher the VIX, the more uncertain and volatile the market is perceived to be. And as we all know, uncertainty and volatility make investors skittish.
So it's like a feedback loop. Uncertainty breeds volatility, which breeds more uncertainty.
Exactly.
And somewhere in the middle of all this are poor portfolios just trying to stay afloat.
It's a bit of a roller coaster ride, that's for sure. And then there's the looming question of a potential recession. While some analysts are downplaying the risk, the possibility is still out there.
Yeah, that's the one word no one wants to hear, especially on a Friday.
Right.
The Wall Street Journal had a piece titled, "How Tariffs Work," that explored this very topic. They suggested that if trade tensions escalate further, it could have a significant impact on global growth.
Right.
Potentially tipping us into a recession.
It's a delicate balance. On the one hand, you have policymakers trying to protect domestic industries and jobs.
Right.
On the other hand, you have the interconnectedness of the global economy where actions in one country can have ripple effects around the world.
It's like a giant game of Jenga,
Yeah,
where one wrong move could bring the whole tower crashing down.
exactly.
Speaking of potentially risky moves, President Trump's announcement of a strategic Bitcoin reserve certainly caught everyone's attention.
It was definitely a headline-grabbing move. Bloomberg had several articles on this, including Trump signs executive order, creating strategic Bitcoin reserve, crypto stockpile, and Bitcoin drops after Trump executive order disappoints market. But as we discussed earlier, the details of the order weren't quite what the crypto community had hoped for.
Yeah, it seems like they were hoping for a more aggressive move, something that would really signal the government's full-fledged embrace of Bitcoin.
Exactly. They wanted the government to be buying up Bitcoin with taxpayer dollars,
Yeah.
essentially giving it a massive stamp of approval.
Yeah.
But that's not what happened. The order states that the reserve will be funded with Bitcoin that the government already owns mostly from seized assets. So,
So more of a symbolic gesture than a game changer.
right. It's more about acknowledging Bitcoin as a potential reserve asset, not necessarily a primary one. And that's why we're seeing Bitcoin prices dip.
Yeah.
The initial excitement has faded as the reality of the situation sets in.
It's fascinating how much influence President Trump has on the markets.
He does.
Whether it's tariffs, Bitcoin,
Yeah.
or anything in between his actions, send ripples throughout the financial world. It's like everyone's holding their breath, waiting to see what he'll do next.
He's definitely a market mover. There's no doubt about that. But it's important to remember that markets are driven by a complex interplay of factors.
Right.
Trump's policies are just one piece of a much larger puzzle.
And let's not forget about the human element. Fear and greed play a huge role in market movements.
Oh, absolutely.
Sometimes it feels like the market is driven more by emotion than logic.
You're absolutely right. It's easy to get caught up in the headlines and the data.
Yeah.
But at the end of the day, it's people making investment decisions.
Right.
And those decisions are often influenced by their emotions, their biases, and their gut feelings.
So with all this swirling around the economic turmoil, the political uncertainty, the unpredictable nature of the markets,
Right.
what's an investor to do? What advice would you give to our listeners as they try to navigate these turbulent times?
That's the million-dollar question, isn't it? If I had all the answers, I wouldn't be sitting here talking to you. I'd be sipping cocktails on my private isler.
Right.
But seriously, there are a few key things to keep in mind.
Yeah.
First and foremost, don't panic. It's easy to get swept up in the fear and make impulsive decisions, but that's rarely a winning strategy.
Right. Take a deep breath,
Oh,
step back from the ledge,
exactly.
and try to see the bigger picture.
Exactly. Second, stay informed.
Okay.
Keep up with the news,
Yes.
but be discerning.
Right.
There's a lot of noise out there.
For so much.
So focus on reputable sources and don't believe everything you read on social media.
And don't forget to do your own research.
Yes.
Don't just blindly follow the crowd. Think for yourself.
Absolutely. Think critically, ask questions, and challenge assumptions.
Love it.
And finally, remember that diversification is your friend.
Yes.
Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes to reduce risk.
That's classic advice.
It
But it's timeless for a reason.
is.
Whether the market is booming or busting, diversification is key to weathering the storm.
Exactly. The goal is to ride out the waves and come out stronger on the other side.
So we've talked about the global markets, the political landscape, the psychology of investing. It's a lot to digest.
It is.
But there's another story developing that I think is worth exploring, the changing face of retail. What do you make of the Walgreens deal?
It's a fascinating development. The Wall Street Journal had a great article titled, Walgreens Seals $10 Billion Take Private Deal with Sycamore, that breaks down all the details after nearly a century as a public company, Walgreens is going private. It's a bold move by Sycamore Partners, the private equity firm behind the deal.
And Walgreens has been struggling to keep up with the changing retail landscape.
Yeah.
So maybe this will give them the flexibility they need to adapt and thrive.
That's the idea anyway. Taking a company private gives you more freedom to make big changes without the constant scrutiny of the public markets. You can focus on long-term strategies and make tough decisions that might be unpopular in the short term,
Right.
but ultimately benefit the company in the long run.
The Wall Street Journal mentioned that Sycamore has a track record of successfully restructuring retail businesses.
They do.
So maybe they're the right team to turn things around.
Time will tell, but it will be interesting to watch how this unfolds. The Walgreens deal is just one example of the larger trends reshaping the retail industry.
Right.
We're seeing a massive shift.
Consumers are demanding convenience, lower prices, and a wider selection.
Right.
And online retailers are delivering on all fronts.
Exactly. For traditional retailers like Walgreens, it's adapt or die. They need to find ways to provide value beyond just selling products. They need to create experiences, build communities, and offer personalized services that differentiate them from the online giants.
And they need to leverage technology to connect with consumers in new and innovative ways. It's not just about selling products anymore.
Right.
It's about building relationships and creating a seamless customer experience.
Absolutely. The retail landscape is undergoing a radical transformation. The companies that survive will be the ones that embrace change and find ways to thrive in this new environment.
So from volatile markets and trade wars to Bitcoin and the evolution of retail, it's been another week of nonstop action in the financial world.
It certainly has. And amidst all the chaos and uncertainty, there's one thing that remains constant: the importance of staying informed, thinking critically, and making smart decisions.
Knowledge is power, especially in the world of finance.
It is.
The more you understand about the forces shaping the markets, the better equipped you'll be to navigate the ups and downs and achieve your financial goals.
Well said. So keep learning, keep exploring, and keep challenging your assumptions.
And don't forget to have a little fun along the way.
Yeah.
After all, investing shouldn't feel like a chore.
No.
It should be a journey of discovery and growth.
Absolutely. Embrace the challenge, enjoy the ride, and remember that even the most turbulent markets eventually find their footing.
Yeah, it's like the financial world is a constantly shifting kaleidoscope.
Right?
You know, what seems like a sure thing today could be a frisky gamble tomorrow.
Absolutely.
That's why adaptability and staying informed are so crucial.
Exactly. Don't be afraid to adjust your strategy as the landscape changes. Sometimes the smartest move is to take a step back, observe, and wait for the dust to settle before making any major decisions. You don't have to jump into every trade.
Right. And don't forget about our old friend diversification.
Oh, yeah, always.
Spread those investments across different asset classes. Think of it like a financial safety net.
I love that. That's a great way to put it. You're not putting all your eggs in one basket. So if one area takes a hit, you're not completely wiped out. Exactly.
But I think it's important to remember that investing isn't just about numbers, charts, and spreadsheets.
Right. It's about understanding the bigger picture, the forces shaping the world. Politics, economics, technology, social trends, they all play a part in the financial landscape. The more you understand about these forces, the better equipped you'll be to make informed decisions.
It's like connecting the dots.
Yeah.
You start to see the patterns and understand why things are happening the way they are. That's what makes investing so fascinating. It's a constant learning experience.
Absolutely. And don't be afraid to ask for help along the way. There are so many resources available: financial advisors, online platforms, podcasts like ours.
Right.
There's a wealth of information out there to guide you on your financial journey.
That's so true. We're all in this together.
We are.
So keep learning, keep exploring, and keep challenging your assumptions.
And most importantly, stay curious.
Yes.
The financial world is constantly evolving, and there's always something new to discover.
Well said. Well, folks, we've covered a lot of ground today, from market turmoil and trade wars to the changing face of retail and the wild world of crypto.
Mm-hmm.
We hope you found this deep dive insightful and informative.
We're here to help you make sense of the complex world of finance and empower you to make smart decisions.
Because at the end of the day, that's what it's all about: taking control of your financial future and achieving your goals.
So stay informed, stay engaged, and stay tuned for more deep dives into the world of finance.
We'll see you all Monday morning with fresh headlines from the major financial magazines.